Ever dreamt of building wealth like the Oracle of Omaha himself, Warren Buffett? But what if you only have a small amount to start with? Fear not, aspiring investors. Hello business minds and entrepreneurs. Welcome back to Business Mind Talks channel. Today, we unlock the secrets of investing like Warren Buffett, even with limited funds. The Buffett way, long-term value investing. Forget the latest stock craze or the hottest IPO. Think like a business owner. Invest in companies with strong competitive advantages, like Coca-Cola's brand or Berkshire Hathaway's diversified portfolio.
The important thing is to be able to define which ones you can come to an intelligent decision on and which ones are beyond your capacity to evaluate. You don't have to be right about thousands and thousands and thousands of companies. You only have to be right about a couple. I met Bill Gates on July 5th, 1991. We were out in Seattle. And Bill said, "You've got to have a computer." And I said, "Why?" And he said, "Well," he said, "you can do your income tax on it." I said, "I don't have any income. Berkshire doesn't pay a dividend." He said, "Well, you can keep track of your portfolio." And I said, "I only have one stock." I said, and he says, "It's going to change everything." And I said, "Well, will it change whether people chew gum?" And he said, "Well, probably not." And I said, "Well, will it change what kind of gum they chew?" And I said, "Well, then I'll stick to chewing gum and you stick to computers, you know." I don't have to understand all kinds of business. There's all kinds of business I don't understand. But there's thousands of opportunities there. I did understand the Bank of America, you know, and I'll be able, I'm able to do that. I'm able to understand some given percentage. But Ted Williams wrote a book called The Science of Hitting. And in The Science of Hitting, he's got a diagram. It shows him at the plate. And he's got the strike zone divided into 77 squares, each the size of a baseball. And he says, if I only swing at pitches in my sweet zone, which he shows there, and he has what his batting average would be, which is 400. If he had to swing at low outside pitches, but still in the strike zone, his average would be 230. He said the most important thing in hitting is waiting for the right pitch. Now, he was at a disadvantage because if the count was 0-2 or 1-2 or so on, even if that ball was down where he was only going to bat 230, he had to swing at it. In investing, there's no called strikes. People can throw Microsoft at me and, you know, you name it, any stock, General Motors, and I don't have to swing. And nobody's going to call me out on called strikes. I only get a strike called if I swing at a pitch and miss. So I can wait there and look at thousands of companies day after day, and only when I see something I understand and when I like the price at which it's selling, then if I swing, if I hit it, fine. If I miss it, it's a strike. But it's an enormously advantageous game, and it's a terrible mistake to think you have to have an opinion on everything. You only have to have an opinion on a few things. In fact, I've told students, if when they got out of school, they got a punch card with 20 punches on it, and that's all the investment decisions they got to make in their entire life, they would get very rich because they would think very hard about each one. And you don't need 20 right decisions to get very rich. You know, 4 or 5 will probably do it over time. So I don't worry too much about the things I don't understand. If you understand some of these businesses that are coming along and can spot things on, if you can spot on Amazon, for example, I mean, it's a tremendous accomplishment what Jeff Bezos has done. And I tip my hat to him. He's a wonderful businessman. He's a good guy, too. But could I have anticipated that he would be the success and 10 others wouldn't be? I'm not good enough to do that. But fortunately, I don't have to. You know, I don't have to form an opinion on Amazon. And I did form an opinion on the Bank of America. And I formed an opinion on Coca-Cola. I mean, Coca-Cola's been around since 1886. There's 1.8 billion 8-ounce servings of Coca-Cola products sold every day. Now, if you take 1 penny and get 1 penny extra, that's $18 million a day. And 18 million times 365 is 7 billion, 3 less 730 billion, or $6,570 million. So annually $6,570,000,000 from one penny. You think Coca-Cola is worth a penny more than Joe's Cola? I think so. So, and I've got about 127 years of history that would indicate it. So those are the kind of decisions I like to make. And you may have an entirely different field of expertise than I would have, probably much more up to date in terms of the kind of businesses that we're seeing evolve. And you can get very rich if you just understand a few of them and understand their future. But
finding value, diamonds in the rough. Buffett doesn't chase the crowd. He researches, analyzes, and understands the companies he invests in. He digs for undervalued gems, often smaller companies that may escape the attention of big investors.
Well, intrinsic value is the number that if you were all-knowing about the future and could predict all the cash that a business would give you between now and Judgment Day, discounted at the proper discount rate, that number is what the intrinsic value of a business is. In other words, the only reason for making an investment and laying out money now is to get more money later on, right? That's what investing is all about. Now, when you look at a stock, when you look at a bond, so it means the United States government bond, it's very easy to tell how much you're going to get back. It says it right on the bond. It says when you get the interest payments, it says when you get the principal. So it's very easy to figure out the value of a bond. It can change tomorrow if interest rates change, but the cash flows are printed on the bond. The cash flows aren't printed on a stock certificate. That's the job of the analyst, is to print out, change that stock certificate, which represents an interest in the business, and change that into a bond and say, this is what I think it's going to pay out in the future. When we buy, some new machine for Shaw to make carpet, that's what we're thinking about, obviously, and you all learn that in business school. But it's the same thing for a big business. If you buy Coca-Cola today, the company is selling for about $110 to $15 billion in the market. The question is, if you had 110 or 15 billion, you wouldn't be listening to me, but I'd be listening to you incidentally. But the question is, would you lay it out today to get what the Coca-Cola company is going to deliver to you over the next 200 or 300 years? The discount rate doesn't make much difference as you get further out. And that is a question of how much cash they're going to give you. It isn't a question of, it isn't a question about how many analysts are going to recommend it or what the volume in the stock is or what the chart looks like or anything. It's a question of how much cash it's going to give you. That's the only reason. It's true if you're buying a farm. It's true if you're buying an apartment house. Any financial asset. Oil in the ground, you're laying out cash now to get more cash back later on. And the question is how much are you going to get, when are you going to get it, and how sure are you? And when I calculate intrinsic value of a business, when we buy businesses, and whether we're buying all of a business or a little piece of a business, I always think we're buying the whole business because that's my approach to it. I look at it and say, what will come out of this business and when? And what you really like, of course, is them to be able to use the money they earn and earn higher returns on it as you go along. I mean, Berkshire has never distributed anything to its shareholders, but its ability to distribute goes up as the value of the businesses we own increases. We can compound it internally, but the real question is, Berkshire selling for, we'll say, 105 or so billion now. What can we distribute from that 100? If you're going to buy the whole company for 105 billion now, can we distribute enough cash to you soon enough to make it sensible at present interest rates to lay out that cash now? And that's what it gets down to. And if you can't answer that question, you can't buy the stock. You can gamble in the stock if you want to, or your neighbors can buy it. But if you don't answer that question, and I can't answer that for internet companies, for example. There are a lot of companies, there are all kinds of companies I can't answer it for, but I just stay away from those.
Let's pause for a while and all ears here, business minds. Are you ready to take control of your financial future? I have something special to unveil, an exclusive online course that promises to empower you in the world of investments. Cash Flow Academia. This course is designed for everyone, from beginners dipping their toes into the investment waters to seasoned pros seeking advanced strategies. Don't miss this opportunity to take charge of your financial future. Click Click the links below and enroll now.
Patience is key, riding out the storms. The market will be volatile. There will be ups and downs. But Buffett teaches us to be patient. Don't panic sell during dips. Hold onto your quality investments and let the power of compounding work its magic over time.
In the securities business, you literally every day have thousands of the major American corporations offered to you at a price that changes daily. And you don't have to make any decisions. You have to make, nothing is forced upon you. So there are no called strikes in the business. The pitcher just stands there and throws balls at you. And if you're playing real baseball and it's between the knees and the shoulders, you either swing or you get a strike called on you. If you get too many called on you, you're out. In the securities business, you sit there and they throw U.S. Steel at 25 and they throw General Motors at 68, and you don't have to swing at any of them. They may be wonderful pitches to swing at, but if you don't know enough, you don't have to swing. And you can sit there and watch thousands of pitches, and finally you get one right there where you want it, something that you understand, and then you swing. And
so you might not swing for 6 months.
You might not swing for 2 years.
Isn't that boring?
It would bore most people, and certainly boredom is a problem with most professional money managers. If they try to sit out an inning or two, not only do they get somewhat antsy, but their clients will start yelling, "Swing, you bum!" from the stands, and that's very tough for people to do.
Remember, investing is a marathon, not a sprint. Be disciplined, stay calm, and trust your long-term strategy. Small steps, big results, investing on a budget. You don't need millions to get started. Even small, consistent investments can snowball into significant wealth over time. Start with what you can afford, contribute regularly, and take advantage of dollar cost averaging to mitigate market fluctuations.
Yeah, if I were working with small sums, I certainly would be much more inclined to look among what you might call classic Graham stocks, very low P's and maybe below working capital, all that. Although, and I would do far better percentage-wise if I were working with small sums. There are just way more opportunities. If you're working with a small sum, you have thousands and thousands of potential opportunities, and when we work with large sums, we have relatively few possibilities in the investment world that can make a real difference in our net worth. So you have a huge advantage over me if you're working with very little money, but there are compensations to that on the other side of the equation. The Korean stocks you mentioned that I looked at 6 or 7 years ago were companies where you could only put a small amount of money in, and I was sort of reliving my youth. Somebody sent me a handbook of Korean stocks and told me that the market was interesting. So one Sunday afternoon, I did leaf through a couple thousand pages of Korean stocks, and I was sort of reliving my youth. I mean, other people look through old Playboy magazines or something like that, but I looked through these old manuals of stocks, and I bought a number of stocks in small amounts from companies whose names I couldn't pronounce. But the stocks as a group were so cheap that you had to make money out of them. They were Graham type stocks, and that's what I would be doing. I would be combing that sort of a list. Now, if I found a wonderful company that Graham wouldn't have bought, but I really was convinced about its future, I would have bought that also. Incidentally, I've written in the last annual report about Geico, and I bought that stock in 1951 when I had about $10,000. And Geico I looked at because Benjamin Graham was the chairman of the company. But Geico was exactly the sort of stock that Graham wouldn't buy. I mean, it was selling way above book value and all of that. There was a certain irony in that.
Remember, Warren Buffett wasn't born a billionaire. He built his fortune through smart and disciplined investing. By applying his principles, even with little money, you can embark on your own journey toward financial freedom. So, take the first step, invest wisely, and let the magic of compounding work its wonders. Let's build a community of smart and successful investors. Thank you for watching. If you found this video a helpful one, please like, subscribe, and hit that notification bell.